Welcome back to Wall Street Podcast. Today, we're diving deep into the gold market. It's seen some incredible highs recently, just mind-boggling peaks. But, and here's the catch, our latest analysis suggests that maybe, just maybe, the momentum driving it, well, it might be starting to fade. What's really going on?
Exactly. And the basis for our deep dive today is a really comprehensive research report. It's titled Gold Outlook Momentum Fading. It's from HSBC Securities USA Inc. And it just came out July 1, 2025. So very fresh perspective.
Right. And our mission here is to basically distill the critical insights from this top-tier analysis. We want to look at what's been pushing gold up, what could be holding it back, and really what you, our listeners, should maybe expect in the coming quarters. Because let's not forget, gold hit a record USD 3,500 an ounce back on April 22nd. So despite that amazing strength, this report is suggesting the momentum is waning. That's why.
Well, that's a big idea we need to unpack. Okay, so let's get into it. The report kicks things off by highlighting this potent mix, right? Safe haven buying, risk-off purchases fueling the rise. What are the key catalysts here? What's pushed gold so high? Well, a huge piece of the puzzle is global tension. It's become a primary driver. You look at the ongoing war in Ukraine, the conflicts in the Middle East, shifts in U.S. foreign policy. All these escalating geopolitical risks have really boosted demand for gold. I mean, academic research backs this up time and again. Gold's historical role as a hedge against this kind of uncertainty. It's like a financial lightning rod.
A geopolitical thermometer almost.
Yeah.
But then the report throws in this really interesting observation about the market being, quote, fully loaded. What's that about?
Right, that's a crucial point they make.
Yeah.
They note that gold, pretty conspicuously, failed to push past that April high, the USD 3,500 level, even after those recent strikes on Iran.
Yeah.
So HSBC suspects that unless we see an even greater escalation, something really significant, the market might have already priced in the current level of geopolitical risk.
Oh, okay.
Which means, to get new highs, you might need something even more destabilizing. It tells you something about market sensitivity right now.
So a pretty major event happens, and gold shrugs it off, more or less. Suggests the saturation point, maybe? Beyond direct conflict, though, what about economic uncertainty? How does that play in?
That's definitely another key pillar. There's a pretty clear link between gold prices and the U.S. Economic Policy Uncertainty Index, the EPU. When uncertainty climbs, gold prices tend to follow suit. It reinforces that safe haven status, especially when the wider economy is dragging down other assets. Investors look for stability.
In trade, we've seen so much disruption, tariffs, disputes. How do trade dynamics feed into this gold story?
Yeah, trade dynamics generally show an inverse relationship with gold. So things like tariffs, trade disputes, even just slowing global trade flows, they've actually been positive for gold. And HSBC's latest forecasts, they're pretty weak for global trade growth, just 1.8% in 2025, and even lower, 0.6% in 2026.
Wow, that's low.
It is. And that weakness, reflecting those broader economic anxieties, is enough to keep supporting gold prices from that angle.
Okay, this is where things get really fascinating for me. Geopolitics is clearly front and center, but the report also digs into monetary policy, government debt, the dollar. It's a complex interplay. How is all that shaping where gold is heading?
It's definitely a complex dance, as you say. Traditionally, think of gold as a non-yielding asset, right? So it does better when real interest rates are low or negative. But here's the disconnect. Gold rallied strongly in 2024, even though we had elevated U.S. Treasury yields, positive real yield.
Hey, that seemed counterintuitive.
It did. And it was largely driven by the expectation of really strong Fed rate cuts that just haven't come through as aggressively as the market initially priced in.
So it was more about the hope for cuts than the reality. That's a key difference.
Exactly. Hope versus reality. Now, HSBC's U.S. economist, Ryan Wang, he's adjusted his forecast. He's only seeing 3 25 basis point cuts now September, December, and then next March. That implies much shallower easing than people thought maybe 6 months ago. And that's, well, less bullish for gold. It changes the narrative.
And it's not just about rates, is it? The report seems to really hammer home the impact of government debt.
Oh, absolutely. It makes a strong case that mounting U.S. fiscal deficits, and deficits in other countries too, have been a major tailwind for gold, possibly even rivaling monetary policy's influence now. I mean, look at the IMF forecasts. Global public debt hitting 100% of GDP before 2030, maybe even 117% by 2027 if things go badly wrong.
Staggering numbers.
They are. And you have a respected economist like Ken Rogoff saying U.S. fiscal policy is basically running off the rails. That kind of potential crisis. Intuitively, it's good for gold. We're already seeing signs, like investors reportedly shifting out of long-dated U.S. bonds because of debt worries. that implicitly supports gold.
That's a huge underlying current. And the dollar, we usually think inverse relationship there.
Yeah, that general inverse link still holds. And HSBC's FX research actually forecasts a moderately weaker dollar in the second half of 25. They're calling for EUR/USD at 1.20, GBP/USD at 1.37.
So that would help gold.
It would. But beyond the short-term forecast, there's this growing de-dollarization argument. You hear figures like PBOC Governor Pan Gongsheng talking about wanting a multipolar international monetary system. Even if that shift is gradual, central banks looking to reduce USD exposure. That's seen as structurally positive for gold.
Right, broadening its appeal beyond just the usual factors. Okay, so we have all these big macro forces swirling around. But what does it actually mean for who's buying the gold? The report breaks down investor versus physical demand, and it looks like, well, two very different trends.
You're spot on. Two distinct paths emerging right now. On the institutional investor side, things look quite strong, actually. A real rebound. Take gold ETFs, those exchange-traded funds. After years of outflows, liquidations, we're seeing rapid accumulation this year. Almost 8 million ounces. That's 247 tons year to date.
Wow, that's a significant inflow.
It really is. It signals that institutional money is coming back looking for portfolio diversification. And if you look at CME net long positions, basically, bets on rising prices in the futures market while they've eased off peaks, they're still high, consistent with strong prices.
Okay, so the big money is still interested. But what about the traditional physical side?
Right.
Jewelry, coins. What happens when prices are this high?
Ah, yes. That's what the report calls the weak link. Record prices are causing serious demand destruction, especially in jewelry, which is usually about half of global demand. In Q1 2025, jewelry demand just plunged, down a massive 21% compared to the year before.
21%.
Yeah, and in key markets, mainland China saw a 5-year low. India, demand crashed 25%. These are very price-sensitive consumers, and they're just saying no thanks at these levels. HSBC is forecasting a really sharp drop for jewelry demand this year, 2025, and only a very slow, tepid recovery in 2026.
That's a huge chunk of the market taking a major hit. What about coins and bars? Same story.
Mostly, yes, for coins. Demand there has also dropped significantly. U.S. mint sales, for example, were down something like 72% in May 2025. The report blames high prices, sure, but also maybe the market was saturated from previous buying sprees and there's more supply coming back onto the secondary market.
Okay.
But interestingly, demand for bars, the larger physical bars, has held up better. Q1 purchases were actually up 14%.
So a shift within physical demand.
It looks like it. A price-led shift away from the smaller quasi-investment stuff like jewelry and coins towards the larger physical bars. And that seems driven more by institutional interest than Chinese insurance companies. Maybe even anticipating things like that potential U.S. mutual fund rule change, allowing some gold holdings.
Fascinating. Okay, let's shift gears to supply and, of course, the massive influence of central banks. And what's the picture in the mines and the vaults?
Right. On the supply side, high prices are doing what you'd expect, incentivizing more mine production. We hit a record 3,673 tons in 2024. But the miners are facing headwinds, declining ore grades, reserve depletion. It means future gains are likely to be more modest. The forecast for 2025 is only slightly higher, around 3,750 tons. It's just getting harder to pull more out of the ground.
So output is up, but maybe nearing a plateau. What about recycling, bringing old gold back?
Yeah, recycling or scrap supply is definitely picking up steam. High prices are a great motivator. It was up 11% in 2024, making it the second biggest source of supply. And the expectation is that scrap supply will increase further this year as more jewelry and old holdings get melted down.
Makes sense. But then the central banks, they've been on an unprecedented buying spree.
They really have. The report calls it a near explosion in central bank demand. And honestly, that's been the primary driver of this whole gold rally since 2022. Over 1,000 tons bought each year. Think about this. Gold now makes up 20% of global foreign exchange reserves. That's huge. It's surpassed the euro, second only to the US dollar.
And the motivation behind this massive buying?
It's multifaceted. Diversification away from the dollar is key. Hedging against geopolitical risk, absolutely. And also concerns about the weaponization of currencies. Seeing sanctions imposed on Russia's reserves likely push some central banks faster towards gold.
A strategic shift,
Yeah.
not just financial.
Definitely. Poland's a big buyer, but it's a broader trend across emerging market central banks. They're worried about systemic risk, and gold is, well, convertible into anything in a crisis. Now, HSBC doesn't expect buying to stay at those rapacious levels of 2022-2024, but they still see it remaining historically very high, forecasting 955 tons in 2025, maybe 900 tons in 2026. So it acts as a significant bulwark supporting prices. Although the report does note some reluctance from central banks to buy aggressively much above USD 3,000 an ounce. So even they have price limits, it seems.
Okay, this deep dive has certainly painted a complex, nuanced picture. Let's try to pull out some key strategic questions that arise from all this analysis, things for you listening to really consider.
Absolutely. This HSBC report definitely raises some critical points.
First off, you've got these conflicting signals, right? Strong macro drivers, geopolitics, debt, but then physical demand is weak and maybe the market's fully loaded. So what's the actual near-term path for gold and how much volatility should we brace for?
Well, the near-term momentum still seems tilted bullish, mainly because those big risks, geopolitical, fiscal policy uncertainty, they aren't going away quickly. However, that failure to break $3,500 after the Iran incident does suggest the market might be a bit toppy or fully loaded, like we discussed. So HSBC is forecasting a pretty wide and volatile trading range for the rest of the year. Think $3,600 on the high end, maybe $3,100 on the low end.
A $500 range, quite volatile.
Exactly. They don't expect a major collapse, but prices are likely to pull back a bit, consolidate, but stay comfortably above $3,000. And only a moderate adjustment lower in 2026, because the underlying risks driving demand are still expected to be high. So yeah, expect choppiness, but within a historically high range.
Okay, that gives us a framework for the near term. Second big question. This shift in why gold is rallying, it seems less about traditional things like real yields and more about these bigger geopolitical and fiscal worries. How significant is that shift, and what does it mean for gold's long-term role as a safe haven?
I think it's very significant. Historically, yes, gold had that strong inverse link to real rates and the dollar. But the report clearly shows that link has weakened, or at least been overshadowed recently. The primary drivers have shifted to geopolitics, sovereign debt concerns, and this whole de-dollarization narrative. It suggests gold's safe haven role is now perhaps more fundamentally tied to these deep systemic uncertainties than just week-to-week changes in interest rate expectations. This arguably reinforces its long-term place in the financial system. It becomes that golden port in a storm for potentially years to come, especially when you factor in those multi-year central bank buying plans. It's a recalibration of its appeal.
A fundamental recalibration. Fascinating. Okay, final point. This divergence we talked about. You have investors' ETFs piling in while traditional physical buyers, jewelry, coins are backing away sharply. What impact does that have on how prices are set, on price discovery, and what does it mean for absorbing all this gold going forward?
That divergence is crucial. You've got strong institutional and investor demand,
Right.
particularly flowing into ETFs and large bars that's capital returning. But on the flip side, record prices are crushing demand in the traditional physical markets, especially in Asia. Now, investor flows and futures trading influence prices very quickly, day to day. Changes in physical demand, like jewelry sales dropping, feed through much more slowly.
Right.
So this divergence means potentially large amounts of physical bullion are being left unsold in those traditional channels. That metal needs to be absorbed somewhere, primarily by the investment community. If that investor absorption doesn't keep pace, maybe because sentiment shifts or there isn't enough fresh bad news to trigger more buying, then the sheer weight of that unsold physical gold could eventually start to ease prices lower. The lack of underlying physical buying becomes a drag. It's a delicate balance.
A delicate balance indeed. So, recapping the core insights, gold is holding at historically high levels, clearly supported by persistent geopolitical tensions and serious fiscal worries. But it's facing real headwinds. Central bank buying might moderate slightly from peak levels, and physical demand, especially jewelry, has seen significant destruction due to price. So for you, the astute investor listening, here's something to mull over. How might future shifts in global economic stability or instability reshape not just how central banks diversify, but also how you approach gold as a core store of value in your own strategy? What's your next move? We'll leave you to reflect on that.